So I made $2,103 profit today, and the profits were made today with a very good market
anywhere. What other options might they explore at this point, since we already did a release of barrels from the Strategic Petroleum Reserve?
Well, the administration could still go back to that option. They could always release more from the emergency reserves, and they could try to discuss another coordinated reserve with allies around the world, similar to what happened in November. There are discussions underway nearly every day on this front to try to coordinate, especially with a possible invasion of Ukraine by Russia. The White House pointed that out again in a briefing just a few moments ago. So certainly that is still on the table, Kelly. But the impact is short term, as we saw. The price of gas at the pump is still back where it was, higher than where it was before the White House did that back in November. But I think the main point to keep in mind with this proposal for the federal gas tax is primarily just to show voters that they're talking about things they can do, that they're aware that it hurts people's pocketbooks, that they are at least trying to put things on the table, even though behind the scenes what I'm hearing from a lot of aides is, that there aren't that many pros to it. It's really hard to put something like this back in place once you roll it back.
Yeah, and if they were to let it go for a while, would they just borrow and still put $45 billion towards highway repairs, or would that money not be available?
Well, they can always pass new legislation trying to find new revenues from somewhere else, but that's another one of those issues that the Highway Trust Fund needs that money. That is one point that the Chamber of Commerce has raised in opposing any potential rollback of the gas tax. So certainly there are a lot of critics of doing this, even though the White House is trying to show voters it cares.
Kayla, thank you. Kayla Townshey with the latest. All right, that does it for the exchange, everybody. Power Lunch picks things up right now.
Kelly, thank you very much. And breaking this hour, the Fed minutes. Details from the central bank's last meeting are being released at this hour. Investors will be looking for clues on the size of a potential rate hike in March. Also about its shrinking balance sheet and other ways the Fed plans to fight the hottest inflation in 40 years. A big hour ahead, Kelly.
All right. Hi, Tyler. Hi, everybody. Let's get a quick check on the markets. Here's where we stand as we await the Fed headlines. Dow's down 232, so about 150 points off session lows. S&P down 24. NASDAQ down 136. Let's check on that 10-year yield as well, see where that's standing. The latest is about 2.063%, so we might already be getting some movement there.
All righty, let's get right to our Fed panel of experts. Tiffany Wilding is PIMCO's chief U.S. economist, and Greg DiMarzo is portfolio manager with Rockland Trust. Mike Santoli with us, as is Rick Santelli, who will help bring us the headlines as they cross. And Steve Leisman will be joining us in just a few moments. Let me go to you, Rick, if I might. What are you looking for out of these minutes?
Well, it gets a little bit tough, Tyler, because in a way, the January 25th, 26th meeting and the minutes therein might be considered a bit old, because since then, we've had a big jobs report. We've had updates on both inflation numbers, CPI and PPI. Both of those were hot. Every release actually has had any pricing component has been rather on the hot side, and especially February 4th on that jobs day. We had 467,000 jobs. He had 709,000 just in revisions. So that one-day pop in jobs, just that one day, he added almost 1.2 million jobs. This could change some of the dynamics associated with what they were discussing at the January 25th, 26th meeting. But here's three things I'm looking for quickly. Update on inflation, an update on their $9 trillion balance sheet. That's what everybody I talk to wants to know. When is that going to run off? When are you going to stop buying? And, of course, the hikes. Are they going to begin in this next meeting in just a few weeks? Most people would say yes. I still haven't seen any of the headlines coming across. But as I do, I certainly will shout them out.
Yeah, jump right in when you do get them. Greg, let me turn to you. There's been a tremendous amount of heavy breathing about when and how much interest rates will rise. Has it been overdone by us in the media?
I think possibly. If you look at the number of
significant balance sheet cuts are likely appropriate is the few headlines I'm seeing come out. So the first basic headlines that most of the wire services have to do with the balance sheet, and that completely correlates with everybody's question marks. $9 trillion and that quantitative tightening, of course, is something that could really start to bite. And those minutes did discuss that. I don't know that you're going to see many discussions regarding the half-point hike, which came much later. I will let you continue. Here we see another one. Fed considering moving window to start balance sheet runoff, and that is the second issue. It's all about the timeline.
All right, there you got a little bit of color. The first flash is Greg. Let me let you continue with your answer.
I was only going to say that if you look at the number of hikes that are expected, I think everybody wants the Fed to get off of zero. But I think when Powell talked back in December, it was a matter of wanting to do the balance sheet and the hikes maybe a little bit separately. I think to some of Rick's points, I don't know that they're going to be allowed that time period to be able to do them separately. So I think everybody wants them to get off zero. But as the spring goes on and comps get more difficult, I think they want to watch the data. So I think the market kind of trying to price in 5, 6 hikes might be ahead of itself.
Comps get more difficult. What you're talking about? Economic comps or corporate comps or what?
Both, actually. If you look at the S&P earnings rate, it's declining heavily going year to year. Obviously, last year was the bounce off of the pandemic low. And similar for CPI and PPI. Obviously, the numbers are very hot right now. And I think we knew that the December, January, February numbers for each were going to be very hot. As we look at March and April, the comparisons to last year get more difficult. We will see a deceleration. Now, we could still be way above the Fed's 2% target. But as the comps get more difficult, they might get a little bit of a grace period.
Tiffany, you say you expect 5 rate hikes this year, with, I guess, only a late July meeting being the one where they might pause. What are the odds that any of those rate hikes are 50 basis points or 0.5%?
Well, I think the Fed really wants to keep their options open here. Having said that, I do think their preference would be to hike sequentially at every meeting at a 25 basis point pace. Nevertheless, I think we have to keep our minds open to this idea that you could get a 50 basis point rate hike. I think just in terms of data flow going into the March meeting, we have that CPI report that's actually going to come during the blackout period of Fed communication. So it's certainly possible that markets could see that report, price in with near certainty a 50 basis point rate hike, and then I think it's difficult for the Fed not to deliver it. So while we think that the most likely scenario is probably still sequential, 25 basis points per meeting over the next several meetings, we wouldn't rule out that 50 basis point rate hike at this point.
Mike Santoli, what do you think the market wants here?
Well, first of all, the market always wants clarity. The market wants the answers before the test is over. I think, and that sort of shows you a little bit in this modest reaction we got here, that there was no incremental adverse surprise in these minutes relative to what we've heard over the last 3 weeks since the meeting. As Rick was saying, a lot of intervening repricing of the likely path of the Fed since then. I think the market's probably added 1 to 2 hikes to the assumed path since this meeting. So in here, there even were a couple of members, it said in the minutes, who didn't think we were at full employment. Maybe that changed with the last jobs report. So I think what the stock market wants is perhaps some steering toward whether there's going to be a half point to start in March. Maybe we'll get that over the next few weeks. Right now, I think the market figures it's going to be a front-loaded tightening campaign. There was some commentary in the minutes that it'll go faster than the 2015 tightening cycle. Well, nobody thinks that's not the case.
Right.
There was one hike, and then they waited 3 quarters, and then went one hike per quarter. So I do see also the fact that the stock market's up, let's say 4% since the January 24th lows, even as we've repriced for more hikes, maybe tells you that there's some equilibrium we might be approaching here.
Steve, do you have more details on those points for us?
I'll give you a couple headlines here, and then I'll tell you why I think they're not all that exciting. Their expectations for earlier rate increases was in there. Economy employment continued to strengthen. Inflation exceeded the committee's long-run goals. Inflation re-escalated to the upside they were concerned about, and most participants favored a faster pace of increases than previously, and they said the Fed could hike rates even faster if inflation does not move down as quickly as expected. These last two, I'm going to come back to them in just a second, but let me first tell you, I think what happened at the last meeting was Powell did a better job, and I think the press corps did a better job at extracting from him exactly what happened at that meeting. The prior minutes, that was not the case, and the minutes were full of surprises to the upside. Rick suggested this earlier. The market has massively repriced since that last meeting. I think there's 30 or 40 additional basis points in the 2-year. I don't see a reason to be more hawkish or more dovish from these meetings because we've had a bunch of Fed speak. We've had Bullard. Some people come out against Bullard to understand there's a split on the committee about how fast to go. Now I'll come back to those last two headlines that I read to you. The first one says, we're going to go faster than we said previously, and we'll go faster still if inflation doesn't move down. That tells me what I've been reporting, which is that there's at least a decent contingent on the committee that wants to hold back 50. Do your 25s. One of your guests just said, I was listening while I was reading, go in series of 25s, go back, review mid-year, use 50s as the next gear if you need it, if inflation is not responding. That's what I read from these two headlines. It's me doing a lot of reading between the lines there. But overall, the new hawkishness of the committee overall and balance sheet reduction has been priced in by this market. I don't see any additional surprises here.
All right, very interesting.
I apologize to producers for downplaying our story.
Yeah, we're throwing cold water all over this big event we're producing here. But thank you, Steve. Sometimes sensibility trumps everything. Rick Santelli, let's go back to you. I noticed that the 10-year yield moved up rather dramatically. There's the 30-year right at 2 p.m., moved up again as well, and the dollar index down.
Yes, you've nailed it. We saw rates drifting higher within 45 minutes of the release of those minutes we just saw. Now they're drifting back down. A 2-year note yield is down 2 basis points. A 10-year note yield is down 2 basis points. A 30-year bond yield is down about 3/4 of a basis point, and you're down about 1/10 of a cent in the dollar index. Now, none of these numbers are large. I'd pay more attention to the fact that since the moves are not large, the market pretty much anticipated that they weren't going to extract a big amount of new information out of these minutes, and that really does underscore what's important to the market, balance sheet and inflation.
Tiffany, let's go to you. And how do you think this sets up rates for the trade between now and the Fed's actual next meeting next month?
Well, I think that Steve Leisman, kind of hit the nail on the head just in terms of, the potential pace of rate hikes and how that's going to potentially evolve as inflation evolves. I think the really key issue here to the Fed going 50 basis points at a meeting is whether they think that they actually need to take policy into restrictive territory or whether just getting back to neutral right now is okay. And that's really dependent on if inflation does indeed start to moderate as the Fed is hiking. If we're just getting back to neutral, then a sequential meeting pace is probably okay. But if it starts to look like the inflation process has moved higher, and the Fed actually has to go into restrictive territory, then they got a lot more to do. And that's really the scenario that I see that you're going to have 50 basis points. I don't think that we're going to know the answer to that between now and March. So I think that's going to be something that evolves over the course of this year. But I think in terms of the data flow that we get towards March, obviously we have another employment report, we have another inflation report. Any of these reports can be noisy. So I think ultimately it's difficult to tell. Again, we still think that 25 basis points is a more likely outcome, but I think that it's certainly possible you get 50.
Greg, let me conclude with you with an overall thought on the economy. Because there's so many numbers flying around. There are loud and large inflation numbers. There are economic growth numbers. There are everything is moving. There are a lot of moving parts here. What is the underlying real base rate of growth in the American economy as we look out over the next year to 2 years? And what does that imply for equities and the kinds of equities you might want to own?
Well, I think you're asking the million-dollar question. Ironically, if we were talking about an individual stock and you were in the midst of some big event, say it was an acquisition or the like, the question you'd be craving to ask is, what is the organic growth rate? And I think what you're asking, and I don't have a clear answer for, but I think investors are going to start focusing on, is what does the economy look like after inflation? And I know I'm jumping after inflation, and a lot of people might shake their heads, but we will solve inflation one way or another as the year goes on. I actually trust the Fed to do that. And so then the question becomes, what type of economy do we have afterwards? I tend to think that we have a slow and steady growing economy on the other side of this. And that has its positives and negatives.
All right, Steve, can you give us a final wrap here before we go?
Yeah, very quickly. I wanted to make note of what's happening on the curve here. The 2-year has declined quite a bit. Rick noted the 10-year had not. So you do have some steepening of the curve here. My guess is that the market came into this braced for something more hawkish. And now it's not seeing anything more hawkish. And so it's dialing back the concern about the Fed making a major mistake by being too hawkish and too tight up front here. So I'm seeing the 210 curve steepen just a bit here. It's not a huge move, but it's a notable move in the wake of what kind of volatility we've had with these minutes here.
Yeah, and the significance people still ascribe there to the signal. Guys, thank you all so much for covering this with us today. Tiffany Wilding, Greg DeMarzo, Mike Santoli, Rick Santelli, and our own Steve Leisman.
And coming up, inflation hitting all parts of the home buying process. Our special series continues with a look at rising costs for construction materials and which companies have pricing power. Plus, the Crocs CEO, the company reporting record revenue growth, but the stock has fallen about 25% so far this year. We'll get his take on rising input costs, supply chain bottlenecks, consumer demand when Power Lunch returns.